Oracle stock is absolutely flying right now, up 14% after they just delivered what might be the most impressive quarterly results from any tech giant this year. And honestly, I think the market is still not getting it. While everyone was worried about cloud competition and whether Oracle could actually transform itself, Larry Ellison and his team just dropped numbers that show this transformation isn't coming. It's already here, and it's happening way faster than anyone expected. They didn't just beat expectations for Q4 fiscal 2025, they completely destroyed them. Revenue came in at $15.9 billion versus analyst expectations of $15.58 billion. That's over $300 million above what Wall Street was looking for, representing 11% year-over-year growth for a company that's supposed to be mature and slowing down. But here's what gets me excited. This isn't some accounting trick or one-time boost. This is real, sustainable growth driven by enterprise customers who are actually moving their most critical workloads to Oracle's platform, and they're paying premium prices to do it. The full-year numbers paint an even more compelling picture. Oracle just reported $57.4 billion in total revenue, up 9% from last year. But the number that should make every investor pay attention is their remaining performance obligations, $138 billion, up 41% year over year. Think about what that actually means for a second. Oracle has already locked in $138 billion in future revenue commitments from enterprise customers. That's not projected revenue or hoped-for sales. That's contracted, guaranteed future cash flows that are already sitting on their books. When a company can show you that kind of revenue visibility, you're not just buying current performance. You're buying a machine that's already been fed and will keep producing cash for years to come. Most tech companies are fighting for market share and hoping customers will stick around. Oracle has customers who have already committed to paying them for years into the future. That's the difference between a growth story and a cash flow certainty. Larry Ellison made some statements during this earnings call that would sound like typical CEO optimism from most other companies, but with Oracle's numbers, they actually look achievable. He said Oracle will be the #1 cloud database company, and frankly, looking at their growth trajectory, that's not a wild prediction anymore. It's looking more like a roadmap they're already executing. Ellison also mentioned that demand continues to outstrip supply, which is exactly what you want to hear when you're investing in a company in a high-growth market. CEO Safra Catz backed this up by saying, Oracle is the destination for everyone who wants AI workloads, database workloads, and applications. This isn't marketing fluff when their cloud services and license support segment just grew 12% in Q4. Real enterprise customers are actually moving their mission-critical systems to Oracle's platform, and they're willing to pay premium prices because Oracle offers something their competitors simply can't match: decades of database expertise combined with cutting-edge AI capabilities. Here's where Oracle's earnings call gets absolutely explosive for anyone thinking long-term. Management just provided fiscal year 2026 guidance that shows this growth story is actually accelerating, not slowing down. They're projecting over $67 billion in total revenue, which represents 16% growth. Let me repeat that. They just delivered 9% growth, and now they're guiding for 16% growth. That's acceleration, not deceleration. Cloud revenue is expected to grow by more than 40%, and cloud infrastructure revenue by over 70%. These aren't the kind of modest improvements you typically see from established enterprise software companies. These are startup-level growth rates from a company that already has massive scale and profitability. When Oracle says they expect 70% growth in cloud infrastructure revenue, they're not making wild projections based on hope. They're reflecting actual demand they're seeing from enterprise customers who need AI-capable infrastructure at scale, and they're willing to pay for it. Oracle just announced they're planning to spend over $25 billion in capital expenditure for fiscal year 2026. Let that sink in for a moment. Companies don't commit $25 billion unless they're absolutely certain about future demand. This isn't a leap of faith. This is Oracle doubling down because they're seeing enterprise AI adoption happening much faster than most people realize, and they want to make sure they have the infrastructure to capture that demand. This capital expenditure isn't just about building more generic data centers. It's about building the specialized, high-performance infrastructure needed to handle AI workloads at enterprise scale. Oracle understands that the companies willing to pay premium prices for cloud services are the ones running mission-critical AI applications that require the highest levels of performance security and reliability. By investing $25 billion to build that infrastructure now, they're positioning themselves to capture the most valuable customers in the fastest growing segment of the entire cloud market. What makes Oracle absolutely unique in the cloud wars is something most investors don't fully appreciate: their database expertise. While Amazon, Microsoft, and Google are fighting brutal price wars for general cloud workloads, Oracle has built their entire strategy around being the best place to run database and AI workloads. Databases are the backbone of every enterprise application, and migrating databases is one of the most complex, risky, and expensive projects any company can undertake. Oracle's multi-cloud database deployment strategy gives them a massive competitive advantage because enterprises can run Oracle databases on any cloud platform while getting the performance and reliability they need. This means Oracle doesn't have to win the entire cloud infrastructure battle. They just need to be the best database and AI platform, which is exactly what they're becoming. Every time an enterprise deploys an AI application on Oracle's platform, that moat gets deeper and switching costs get higher. Oracle just reported a gross profit margin of 71.12%, which is absolutely incredible for a company investing heavily in cloud infrastructure. Most cloud companies sacrifice profitability for growth, burning cash to acquire customers and gain market share. Oracle is proving you can have both explosive growth and incredible profitability when you focus on high-value enterprise customers who are willing to pay premium prices for premium services. Their operating cash flow hit $20.8 billion for the full year, up 12%. That's real cash generation that can be reinvested in further expansion, returned to shareholders, or used to fund the next phase of growth. When you can grow revenue 16% while maintaining 70% gross margins, you're not just in a good business. You're in a great business that can compound returns for shareholders over many years. The 14% move today reflects the market finally recognizing what Oracle has built, but I think we're still in the early innings of this revaluation. Oracle's transformation from a traditional software company to an AI-powered cloud leader is happening faster than most investors expected, and the financial results are proving that this isn't just a story anymore. It's becoming a dominant market position in one of the fastest-growing segments of technology. Looking at the guidance for fiscal 2026, Oracle expects this acceleration to continue, with cloud infrastructure growing 70% and total revenue growing 16%. When you combine that growth with their massive profitability, strong cash generation, and the $25 billion investment commitment, you're looking at a company that's built for sustained outperformance in a market that's just getting started. This isn't investment advice, but when a company beats earnings by this much, raises guidance this significantly, and shows they're actually winning in AI and cloud infrastructure while maintaining incredible profitability, that's usually the beginning of a re-rating, not the end of one.